Good morning, everyone. Today is Tuesday, May 9th, and this is our Capstone Coffee Conversation. We appreciate you joining, and we're looking forward to getting started today. So today, we are going to be spotlighting Pacer ETFs, a fund company that's responsible for the Cash Cows line of funds that we've been using here at Capstone for a couple of years. And we are joined by Sebastian Kerslake. Thank you for coming, Sebastian.
Thanks, Ryan. Thanks for having me. Thanks, everyone, for being here. So Pacer, we're a rules-based ETF company. We launched our first ETFs in 2015. Our focus has always been on bringing strategies to market that are innovative, that are unique, and that are tax efficient in the areas of performance, like the cash cows and what we'll be talking about today, risk mitigation, as well as yield and income. So again, appreciate all of you for being here, and thanks to Brian for asking us to come out.
Yeah. So let's get right to it. So we're going to cover the who, what, where, when, why, and how of all the free cash flow based funds that Pacer provides. We just covered the who. So Pacer has been around for a number of years, and they try to provide more unique types of funds, not just tracking the S&P 500, but some kind of rule that they're going to help add some value on. So we're going to talk about those today. So the free cash flow funds, some of you may be familiar with those. We've talked about those funds with many different clients. COWZ, COWZ for short, as we call it sometimes, is one of those. And we're going to kind of start with that one and then kind of talk about some of the others. So first of all, we have to understand what is free cash flow. And more specifically, Sebastian, what is free cash flow yield?
Yeah, no, thanks, Brian. So free cash flow, and that's really what we focus on here at Pacer with the Cash Cows ETFs, is free cash flow. It's the cash that's left over after a company has paid all the bills, paid their interest, paid taxes, funded long-term investments. It's how much cash a company is actually generating. So free cash flow yield just takes that one step further. It's a ratio that we use, and it just allows us to identify the companies that are cheap, trading at a discount, tend to have low levels of debt relative to how much cash that business is actually making.
Yeah, I think there's a lot of companies out there that have high free cash flow, but maybe their value as a company is very high. That would not be the types of companies that are in this fund. It'd be more about the high free cash flow, but their value is low, or at least underappreciated. Is that a good way of saying it?
Yeah, that's exactly right. And it fits in the value sleeve of portfolios. So like at Pacer, we really like being problem solvers, right? Work with advisors across the country. We get a lot of feedback. One of the things that we did get was just, kind of challenges with the traditional way of looking at value. And that's really what, inspired us to come out with these Cash Cows ETFs, because we felt like it was an area where we could come in, add value, add a solution, to a problem we thought was in the market today. But you hit the nail right on the head. That this is, fits in the value sleeve. These are companies that are trading at a discount compared to their free cash flow, but also compared to the rest of the market. Yeah.
Right, Moisha, I think we have a slide for this as well. Go to the second page of that. We actually have a term for how this free cash flow to value is described. It's called enterprise value. That's the bottom part of the ratio. Free cash flow compared to the enterprise value. And we have kind of a back test of what this looks like on the second page there, Moisha. It should show how all these different types of factors, when looking at companies, we look at dividend yield, we can look at price to book value, which is a different way of looking at it. We can look at sales growth, all these different factors. And if you look up in the top far left corner, free cash flow, FCF to enterprise value. That's what this fund focuses on. That's the free cash flow, the money a company is making after all their real expenses over their value. And what that shows is on the top left corner there, that's where you want to be. That's where the return is higher and the negative 12-month periods are lower. So obviously that's an interesting graph there to look at to see that, hey, this measure of success for a company is actually really effective when looking at history.
Yeah, no, that's exactly right. And you can see just all the other popular value metrics out there on that chart. None have worked long term as well as free cash flow yield has. And there's been a direct correlation between the companies with a high free cash flow yield and what their long-term performance is. So with the cash cows, we want to just invest with those companies that have the highest free cash flow yield.
So we've talked about the who, the what, now let's talk about the how. So how do we identify these companies? Is our screen share working, Mo? Good, okay. Let's go to the second one that has the funnel of how Pacer comes up with these companies to go to the fund.
Yeah, thanks. So we're 100% rules-based here at Pacer, so we rely really strongly on the data to make those unemotional decisions for us. So what we do is you'll notice it looks just like a filter or a funnel that you're seeing on that page. All the cash cows really work this way. The only difference would be, the index that we start with. We have a large cap, which screens the Russell 1000. Also have small cap, international, global. But they all use this same filter process where we want to start with the index. We'll also take out financials right away from that. The reason is just that free cash flow, it doesn't work for a bank, so we will exclude them altogether. And then we'll run through our funnel. So the first thing we do is we identify the 100 companies with the highest free cash flow yield. Lots of these companies will be ones that we already own, but you'll see some names come in and out every quarter when we do this rebalance process. And then we just take that an extra step further. We don't market cap weight the portfolio. We weight based on actual free cash flow. And you can see the ending results there, what they do from a PE standpoint and a free cash flow yield standpoint. But that's essentially what we're doing every single quarter here. We want to start with the index and filter it down to just those top 100 companies with the highest free cash flow yield. And that's what we're going to own. And because it's an ETF too, very, very tax efficient, where we've never had a cap gain distribution in this strategy, thanks to that ETF wrapper.
Yeah, one of the things that I've really appreciated about these funds over the years is not so much what they hold as when they hold it, right? So Sebastian mentioned that quarterly they do this rebalance. And you were telling me the other day about how the fund used to own a lot more technology back in 2016, 2017, before the value of the company started to skyrocket during the pandemic, and then the fund kind of pulled back and owned more like energy and healthcare. I thought that was very interesting because that timing was very well done, and I think this strategy reflects that. If I can give an example, I think a lot of clients know Meta stock took quite the tumble last year, and I think it ended down about 60% for the year or so. And then right about fourth quarter, its free cash flow to its value met the criteria because they were still making a lot of money, they were still making a lot of free cash flow, but because their price had come down so much, they now qualified to be in the fund. They fit the metrics. And then fourth quarter of last year and first quarter of this year, COWZ kind of rode that recovery a little bit. And it was just kind of a good example to me of, looking at that value versus how much money they're actually making is really important, as it is with any kind of investment. But that was a good example to me of how Meta, is kind of a good case study.
Yeah, it's a great example, and it just speaks to how, the strategy really changes with the market. Like you said, having more in the portfolio in tech, consumer discretionary, healthcare, right, leading up to really last year, right? Those were all big areas of the portfolio for us. But then, our screen picked up on changes in the market. We started shedding some of that tech exposure, some of that discretionary exposure in favor of things like energy, right, which did really, really well last year and is a big holding for us right now. And then you brought up Meta, which was a great example. We screened it into the portfolio when it was cheap relative to its free cash flow. And then we screened it out when it no longer met our criteria and was no longer in that top 100, in favor of finding other opportunities. Yeah.
Gotcha. Perfect. So we've covered the how, the what, the who. What about the why? So why is free cash flow such an important metric for these companies?
A couple things. I mean, at first I'd say, the correlation that we talked about just between, how high a company's free cash flow yield is and how long or how high the long-term performance tends to be for that, right? So that's what we really want to focus on. But if you just think about, a year like last year where you had interest rates rising, right? Difficult circumstances, companies that generate a lot of free cash flow, they're often able to kind of weather that storm, right? Be less reliant on debt. And I think last year was a great example.
Yeah, and I'll throw inflation in there too, right? If their costs are rising, but their free cash flow is still high, that means they're weathering the inflation storm too.
That's exactly right. It's like if you have free cash flow, it means there's cash left over after you've done all your obligations, right?
Right.
So that acts as a a buffer, so to speak, against times like these.
Yeah, I think it also helps you not get over your skis in terms of valuation, right? A lot of clients I run into, a lot of new clients I run into, they talk about a bad experience they've had investing in the past. And usually when I kind of unpack that with them, they bought a company after they heard it was doing well. So they kind of bought towards the top of that, cycle, and then the market comes down and, well, I guess the stock market's rigged, right? It didn't work. I should never do that again. When in reality, we got to look at who's underappreciated, right? And so I really appreciate that this fund, this strategy focuses on those companies that are making that money, but haven't yet experienced the appreciation for that yet. Right?
That's exactly right. And sticking to that rules-based quarterly process, that's going to be unemotional, right? And we're going to go out, and if something no longer meets our criteria, it's too expensive, we are going to screen it out, and we're going to put something new in the portfolio. So sticking to that process, every single quarter has allowed us to keep our PEs very low and our free cash flow yield very high.
Right. Okay, so when is it a good time to own this type of fund then?
Well, I mean, it fits in the value sleeve, right? So that would be like a home game for something like COWZ. But we think there's really never a bad time to own it because of that rebalance process that we just discussed, right? Obviously, there's going to be periods of time where, value or growth will be in favor. And I think this just speaks to having a diversified portfolio, that can work in all market environments. But the cash cows are something that, in a value market tend to do very, very well. But in a growth market and when growth is in favor, they tend to still keep the pace well also, right? Better than other, value strategies that we've seen.
Well, and certainly there's going to be times in the market where the market cares more about these profit metrics like free cash flow versus other times the market might care more about just does the company have a good story, right? Like I think about during the pandemic, everyone, the market really loved Zoom and Peloton and some of these because the thought was, they're going to take over during, a time where we have to all work from home, even though they didn't necessarily have a ton of free cash flow, especially to their value, right? So those ebbs and flows happen, but I go back to that one graph I looked at the beginning, just that we, looking at history, long-term, companies that have free cash flow, the lifeblood of a business, are going to be successful. So I appreciate that a lot. So where does Pacer implement this strategy? And I guess when I think about that, I think about the different tickers that are available. And kudos to the Pacer marketing team and sticking with the cash cow motif, if you will, and coming up with some clever tickers. You want to talk about those?
So they all, I'm sure many of you have seen them, they all have cow named tickers. So it's the cash cows, right? It's the metaphoric cash cows that generate the most cash of their different indexes. So COWZ or COWZ is the biggest one. That's our large cap version. We also have CAF, which is our small cap version.
That's my favorite.
That.
I think that's
CAF.
Fun.
Yeah, it's one of my personal favorites too. Then we also have iCow, which is international. And then we have GCow, which is a global dividend strategy for those looking to generate a little bit more income from the equity side of portfolios. But they really all work the same. We just have different iterations, and a big growth theme for us recently has been the opportunities we're seeing in areas like small caps and international on a relative basis.
Yeah, I mean, I can imagine the same quality metrics of free cash flow to their value would apply anywhere in the world. Right?
Exactly.
And any size of company as well. So I do appreciate that there's a whole herd.
There is. And I skipped right over eCow, which we also have, which is the emerging markets version of the cash cows. And we did just launch a couple of growth versions that are slightly different that we just launched here over the last couple months. So that's something we're very excited about.
Yeah. There's a whole suite available with that. So kudos to the marketing team over at Pacer for coming up with those. All right, I think that covers just about everything. We've done all the who, what, when, where, why, and hows of these funds. Let's go ahead and look at if we have any questions from the crowd in the chat. Moesha?
There is one. How much of their money should an individual investor typically put into COWZ?
That's a great question. That's a great question. I'll kind of take that, Sebastian. So obviously, with any situation, it's going to be different and tailored to that individual investor, right? So it's hard to necessarily say you should have 5% of your funds in COWZ or something like that. I wouldn't necessarily put a number on that because it's going to be different for every client, but certainly having a percentage of your value companies, if you own stocks as well, being in this type of fund, I think makes sense. Having a percentage of your portfolio that focuses on quality, both in the international space, the US space, and in the small and large size company space, it's worth having. But it also depends on your risk level. Some clients might want to be more pedal to the metal and want to look at more companies that aren't as focused on free cash flow right now. So it really depends, as always, is the answer. So talk with your advisor, but good question. Any other questions from the chat or anything like that? Perfect. Well, thank you all for joining. We appreciate your time coming every month. If you're watching this video on the repeat on our Facebook page, go ahead and give us a like. And we appreciate you joining us, and we will see you next month.